What's up, folks? Real quick one today. Again, I was going to do a produced video, but it's really busy day today, and I'm not going to be able to get that produced video out there. So I'm going to go live with you guys for just a second here, and we're going to revisit the mining model spreadsheet. We're going to see how ETH has been performing against the original 1559 mining scenario tool. I'm going to see where things are at, see where rewards at, see where the forecast that I originally had put it in and was predicting it based on the 10 different scenarios. Just kind of, this is what we would consider a latest estimate of where things are at. And, you know, are we going to see a tail off after 1559 on hash rate? How big of an impact would that be or whatever? So we're going to get into it. This is really numbers, you know, the core content stuff around what makes up profitability and all that kind of stuff for miners. So let's do some checkpoints. Let's make some updates to the sheet real quick, and then we'll follow this one a day and a video. So yeah, I see ETC's popping too for folks that are tracking ETC. So let's take a look here. Let me bring this back to where I can still see you guys over here. Real quick. Oh, it went full screen again. I don't know why it keeps going full screen on me. Here we go. There we go. Got it. So let's take a look at current price points. I pull pricing into this sheet through an API. We're going to check it real quick. Basario's price shows it at about 33.09. Let's take a look here and look over at the model. Let's grab ETH price. ETH price is API call 17, C17. Let's go back over to here, paste that in there. Hash rate. I also pull through an API. Let's see, 10 under the APIs tab. And we're going to pull in hash rate. That needs to be an equals. So we're at about 575 terahash. We can validate that through Etherscan here. Let's look at Etherscan, and I mean, I know this is what it is, but where is their network hash rate? Here we go. So it's showing about 588. I mean, they take snapshots. That could have been yesterday's snapshot. It's 588. Right now, it's at 575. This is pulling off of CoinGecko's API charts. So we're going to see that. ETH reward. I also pull that in this API sheet too. Under the model, ETH block rewards about 8.6, 2.86. I think it's a little higher in the last 100 blocks though. I was looking at that just a second ago. Let's pull that one in. Let's do that. It's probably C. There we go. 17. Let me look back here again. Model. That's 13. C13. It's because I pasted it down some, so 13. All right, so 2.86. Now, what's that mean? That means this is the transaction fees. And for anybody that's just following this video, is trying to figure out what the hell I'm doing here, we're just trying to calculate -2, and then the block rewards are equal to 2. So anybody that's tracking Ethereum, every 15 seconds there's a block. Ethereum inflates into the ecosystem 2 coins per block. Anything over that is the transaction fees that are used to move money around within Ethereum, or use Ethereum. You have transaction fees, and that is the 0.86 right now. We can do a quick spot check. I always like spot checking this really quick to show you guys kind of way that works. We're going to Etherscan here. We're going to the latest block information, which, like, this was 17 seconds ago. There'll be another one here. We're going to view all blocks, and we're going to copy. Actually, we're going to go to give me 100 records. 100 records is the last 25 minutes on Ethereum. So we're going to highlight all of these here real quick, copy that, throw that into an Excel sheet here, paste that. we're going to highlight I, Control F. I'm going so fast I can't, computer can't keep up. Ether, and we're going to replace that. We're going to leave nothing with that. We're going to replace that. That gives us the 100 changes. And now I can quickly do an average for you guys. Last 100 blocks. 3.36 is what that's showing. So my API is running a little slow. So 3.36. Let's just put that in there for right now. 3.36, which would be 1.3 ETH per block extra that we're earning. Now, the burning of the base fee, EIP-1559, what it does is it's going to burn the base fee, which there's more technical things with 1559 are in there with predictability and the ability to expand and contract blocks accordingly. But let's look at just the realities of what happens here. And let's look real quick, what's the ETH value here? The total value of this average last 100 blocks has been around $11,000 per block. Of that $11,000, 4,500 of that has been extra fees. So that's the inflation rate, or the extra money that we're getting as miners collectively, and then a typical block at that price should cost 6,600. So you can see there that, you know, it's almost not double, but it's pretty close. And then there's times when there's high network, you know, moving and volatility here, that this transaction fees can be 4, 5, 6 by themselves. So we have like a 10, you know, 8 to 10 ETH block. It hasn't happened in a while since Berlin. It hasn't happened. There's been a little more predictability, and the MEV extraction has came down quite a bit. There's a little more efficiency now with ETH, so we are not seeing crazy, you know, 6 to 10 and 12 block sizes, which has reduced the yields already. But if, let's say, EIP-1559 takes 40% of this right now, 40% times this, and I want this to be you know, not dollars. I want it to be numbers. Oh, I'm not good at this one compared to Excel. So 0.54 of that would be burned if it was 40% burn. And let's say it's 80% of the base fee of this would be a base fee burn, then this would be this times the 80%. And we would burn almost 1 ETH. So what the reality is, and this is what the sell and I think what the buying of the news is with Ethereum, part of the reason why the price has been continuously going up is people are looking at the inflation rate in this particular instance. If it's at 40%, right, this would be not just burning when you're burning the extra fee on top. I've seen a couple of people that were confused. Are like, well, if in this case, if we're burning 0.54, then that just means, you know, you're getting less. You would be getting, you know, a total as a miner, you know, this plus this minus this burn, right? So in a post-world EIP 1559, instead of 3.36 over the last 100 blocks, we would actually only be earning 0.86, right? But the key factor here is that it's actually burning some of the supply. So there is a telling off of supply. So why there's still 2.8 moving around, the thing that you have to understand is when you're burning supply, you're actually burning it from what's going on is you would be burning 0.54 out of the 2. So you're taking 2 minus this. That's actually what's going on. So now you're telling off the supply. So where they're talking about deflationary is that if the burn is equal more than 2. And the reason why I'm going and being more detailed to this is I think people hear the words and they've seen some graphics, but they don't understand really the numbers of what happens here. And it can get confusing because people think, oh, you're still putting into the system 2.86, but in reality, you're moving people's money around with part of it, and then the other inflation part is actually tailing off because you're burning some of the supply. You have a burn function on the supply. And then if you have a block that's higher, then you have a reward that is higher than the two that you're burning. So like, let's take this hypothetically. Let's say the ETH rewards were 8.5. And let's say, yeah, the 6.5 of that was the transaction fees, right? Because 2 is only the inflation. We would be then burning, 2.6 of that F in that particular scenario. So at 40%. So 2.6 is being burned. We would deflate 0.6. This would be your deflation. Your deflation of you would actually be burning supply forever, right? So you're not going to ever increase inflation because they went against Ethereum. Actually went against the EIP I had put in there about popping up the inflation rate to 3, that then would tail off to 1 over a 2-year period, giving everybody time to move to ETH Proof of Stake, and it would take some of the potential issues if EIP-1559 got into one of these scenarios where there was there was a huge tell-off in price for whatever reason, and it went down to like $800, and then you're cutting off 40 to 80% of the supply, or the 40 to 80% of the transaction fee getting burned. Then you would have this like deflationary thing. However, you would be just crushing the amount of hash power that could come out of your network, and that's what these scenarios really were playing out. So part of this was to first explain how this deflation piece works, and hopefully you guys pick up that and understand. Now let's take a quick reality of what does this spreadsheet look like when I forecasted it back in February. So back in February, and I was showing kind of these are different scenarios of GPUs and typical home miner. Let's do a typical modern home miner, 883 mega hash, this much power rate. How much does it cost you per day to run something like that? It costs about $24 in power at 12 cents per kilowatt. Now, the mode selected is corresponding to this reference ID here. So mode selected is FPLV, which would be up here. You can see FPLV would be flat price, low volume, no record offset. Then what would happen here? Now, we're not in a flat price situation. We're in a high price. Extremely high price, here's the models that I had. So an extremely high price setup would be, let's see here, let's go to extremely high price with low volume. I'm going to put low volume because that's kind of where we're at with regards to yield. Volume in this standpoint is how much extra yield are we getting. We're at about 2.8, 2.8 to 3.3 per blocks, which means that extra 0.8 to 1.3 extra ETH per block on the transaction fees. The high volumes that I have set here are for like those times where we were like 4 to 8 to 10 extra ETH per block on the what was moving around. So let's do extremely high price, low volume. So right here, we're in a scenario to where I was forecasting that by April we'd be at 3, by May we'd be at 3,700. My forecast is going on like a profit here on this particular model. Like, so by the end of May, I was projecting in this particular scenario, and mind you, I projected 10 scenarios, so it wasn't like I just picked this out of thin air. I forecasted probabilities of things that could happen with ETH's network in 10 different scenarios. So in this particular one, May would end at $3,700, and then your moderate yields would drop to about 2.08. You guys don't have any sound? My God, I hope I've had sound. Somebody says they don't have sound. So we're a little higher on the yields. We're not at 2.1 or anything like that. We're about 2.86. So it's a little higher yield setup right now. So what I need to do actually is add a model data here is what we call actual. And the actuals I can then make snapshots into here to where you can choose the model selection of actual, and you can see what the realities are from a monthly power, net revenue cost and stuff. So your yields are a little higher, and then I had forecasted at that time that we would be at a net hash of five. I'm pretty close right now. We're at 575. This is at 547. So we're actually out trending what my forecast originally was on net hash. So I had net hash at about 547 terahash. We're at 575. So we're actually coming into June here at the end of June. All these dates were to the end of the date. So by the end of May, I was looking at 547 terahash. We're actually over indexing that at 575 terahash on Eth's network. And on June, I was looking at 588. I think we're going to blow past that. I think we're going to be in the 600s. I think I'm off a month on all of these figures right now, to be honest with you. I think we'll end maybe June, and it's really dependent on Bitmain. It's dependent on Silicon shipping out their ASICs on this network that are 2.8 gigahash each, and what those supply side was on those. And then it's also predicated on if there's a surge of other GPUs. I mean, GPUs have been sold out forever. There's lines every day at Micro Center and all the retail locations. All the new eggs and everything are a disaster. So I don't think we're really seeing a proliferation, as it were, on the GPU side. It's more of the ASICs coming on board that's driving a lot of this huge exponential growth on hash power. But right now in this current forecast, it's still showing, I'm putting an aggressive price schedule out there that people are going to price in EIP 1559 using this concept that if, there's a lot of transaction volume, we're going to see an increase of usage of Ethereum, which then thereby more fees. And then we're going to get into that 4, 5, 6 block output. So we're gonna have the 2 inflation plus 4 to 5 to 6 yield. Now that pushes your profitabilities up quite a bit. If this was like, if I came in here and just adjusted the monthly yields to like a higher rate, or the average block size to a higher rate. So we'll see on price. Price is discovering pretty much on par with what we had here. I think at the end of April, I'd have to look back at Masario. I don't think we hit 3,000 in April. Let's look here. Let's look at last 1 month. So we hit 3,000 May. So I almost had it. So I had, at the end of April, we were at 27.98 and we were pushing our way to 3. I had 3 projected at the end of April, not the beginning of May. So we're just behind it. And now we're sitting there bouncing around the 3s. But I have us ending at this month at, if things are going the way the models are suggesting, at 3,700 ETH price. Now, is that going to happen? Who knows, right? This could quickly fall into one of these low price scenarios to where we've tailed up and then we pull right back down. And you can see, what's this do for monthly net incomes? As long as the price keeps going up, it does not matter that the yields have flattened out to 2. That's what it comes down to. And that was one of the positive scenarios, that price discovery drove up. Even though your yields would be less because the hash rate's going through the moon, your actually output of ETH will decrease, but the value is a lot higher. So you can see, as long as it keeps telling to that price. Now I'm going to go in here and update this and show what happens if price stays flat, but yet the net hash continues to increase. So let's just say this is the thing. Let's say ETH doesn't push past 3,700. We start to see a drop precipitously on yields to where they just flat out at 2. So even the burn doesn't even really matter that much because there's not going to be much on that. But let's say 3,700. 3,700, 3,700, 3,700. Now you can see what happens to your monthly outtake if you had about 883 mega hash. Is your net goes down by about $500-600 equivalent. Which in this case, if the price of an ETH is this, what is your let's do this divided by this. If I do this right, oh, I already had the monthly yields. So there's your monthly yield. Right now with 883 mega hash, with the current net hash, you should be earning about a half of an ETH right now with 883 mega hash, or a little less than half of a mega ETH, because we're at about 575. So you're going to drop to about 0.43, 0.3, or, 0.39, somewhere around that on like this much mega hash. And that's if the net hash goes to about 730 terahash. So that's another, 200 terahash, orders of magnitude higher when compared to like all ETH hash, total terahash prior, right? Remember we were at 120 terahash and it went back up to like 220, 230, and just sat there for a long time through 2017 through 2018. So we're looking at that entire encompassment of that order of magnitude being put on top from now to EIP-1559 as a potential. So I'm just trying to make sure that folks that are mining ETH understand the yields are going to continue to go down because net hash is going up, right? And you're sharing your proportional output with that. Price offsets the impact to you, but it all comes back down to monthly yields of what you're really earning or not, from just the yield and the ability to deploy that, not just pay for your cost. Now these are, your costs are pretty fixed on mining, by and large, but you do have that. Let me put these back to keep the model straight. Now I need to put the added the LE, which is the latest estimate in here. I'm going to add a table down here called latest estimate and then the particular month, which then will just give you an ability to go into this drop down and just put in latest month estimates. So, and that's just a trend analysis of where things are going if you're a miner. I'm going to take some questions. If you guys want to ask some questions, I'm going to try to wrap this one up pretty quick. I wanted to just go through those two main points of kind of where are we tracking. It looks like we're on the EHPLV right now scenario as this, or we're showing an extremely high price work that would have not required an offset, which is what I was pitching before, but I wanted to make sure that people had some view of this. I may take some questions here and then we can go through it. Grant Terry said he bought a cards and a rig in February. So he's spent 20,000 in pounds, makes me $100 a day, 266 ROI. Makes a lot more interest in bank. I should have put that into crypto. Bummer. This has always been a conundrum for people that are mining. Mining's always been a hedge that while the going's good now, if you would have done that and it would have crashed hard, you would at least have your assets and stuff that you could resell, right? And what I've seen some people doing is that if it's not hitting the numbers they wanted, they're actually selling their equipment right now. I know several people right now that are just cashing out at the high GPU prices right now, and they're just like, you know what, I'm gonna take that money and I'm gonna deploy it into crypto. The problem with that is you're also buying at all-time highs. So if you sell your equipment, let's say you bought it RTX 3080 for, let's say you got it for a reasonable price, $950, and you sell it for $1,800. Well, now you just took a double gain, right? You're 100% on top of your hardware, and then if you put that in and you buy an ETH right now, you'd be buying 0.5 ETH. Well, ETH could easily go back down to 1,500 again, right? So now your 0.5 ETH is now worth back to your original price that you paid for your GPU. So that's probably, this is the conundrum, right? So now you're back down to $900 in total value, and you got really nowhere besides you own 0.5 ETH at 1,800. As long as it keeps going up, it's great. But there are some people that are just starting to move because their yields are dropping. That's why I wanted to make a forecast out here for people had an idea of what's the future state look like in Excel in a quick way for you guys to kind of see as net hash goes up what your yields look like. We'll see here. What else we got? Well, layer 2 affect transaction volume. Yes, layer 2 is already affecting transaction volume. So layer 2 stuff like Z.run, things that are running on Polygon are being done in like a bar tab style transaction. So I explained in a few videos ago like how that works, to where a whole bunch of stuff is done on a side chain. So all the microtransactions are zero cost fees on a side chain, and then they make a single post at some other point in time on main chain and pay a small fee to reconcile all those changes. So it's kind of like having a channel open, a channel service open, where you can make all kinds of microtransactions. You don't need to, you inherit the security from layer 1, but you don't need to necessarily reconcile those changes until you're coming out of that layer 2, right? So that's just going to be that slow decline. That's what I was showing here, where the yields were about 3.1 on average, and we've been slowly going back down. A few days ago, yields were setting at we can go back to the yields here. They were about 2.3, which is the lowest I've seen it in a long time. So 0.3 ETH is only being transacted. But I mean, I think we're going to hold pretty constant at that, 2.8 to 3.3 for a while. So you can just pretty much, if you're looking at forecasting your own stuff, put your two ranges in there as your upper and lower bottoms of 2.8 to 3.3 on total yield when you're doing your calculations. As a topic change, are you getting into Chia? No, I had built a small setup, but I'm not gonna go down the hard drive run. If anything, I'd be purchasing of a Chia than buying the hardware for it. Do you ever consider converting to ETC? What do those numbers look like now? I mean, I've moved some stuff with ETC. I mined ETC for a long time. That's one of the go-tos that we have. We had several rigs on ETC and continue to do so. ETC is now up to about 15 terahash or so. So it's following very quickly the price. So I mean, I think today it peaked at close to $100. ETC. So part of the modeling GPU network analysis. Let's look here. Ethereum Classic right now, when I took the first last analysis, was 8.1 terahash of network, and then now that it's at 12 to 15 terahash on the network, I need to update this chart here, which was showing all the different other networks that are mineable and their equivalent potential of count of 3080s, because part of this analysis was to determine when ETH goes to proof of stake, where does the hash rate go if you're a GPU miner. So I wanted to calculate, this is Ethereum's, this is out of all the GPU, and this is all, again, I would call it an attempt at calculating hash rate and then their conversion of hash rate to particular hardware. And I was using a 3080 as a baseline, understanding that I might have a standard deviation of 40 to 50% to the left for older and slower cards. So there might be a higher count of those that could be deployed. But just taken perpetually, if I had everything force projected to Ethereum, that's about 84% of the entire ecosystem on GPU side. This is relevant to ASICs, by the way, because ASICs are hard coded to the algorithm and can't pivot. But things that can pivot, we care about, right? So we care about FPGAs, we care about GPUs that can move networks. So if the total GPU hash rate spread right now looks to be around 85% of the entire encompassment. This is changing. There's actually, I need to update this because there is a lot of more hash rate now on these other tokens. We've essentially doubled the hash rate on ETC now at 15 terahash, but Ethereum has went up also. But most of the lift on Ethereum we know from ASICs, because ASICs have been shipping, they've been deploying, they're in large farms. ETH's hash rate, even though if its percentages went up, is only ASICs. It's not really a lot more GPUs. A lot of the GPUs have been switching to the other networks, right? So we see the increase in ETH Classic. We saw almost a 10x increase in Ravencoin's total hash rate. So everything's perpetually going up with the numbers that are going up. So we're already seeing some pull from Ethereum's GPU scene over to these other coins. So this chart needs to be updated. But again, that's some forecasting and massaging. Let's see here. The A bridges DeFi is coming. I know a lot of projects have reprioritized to go into the DeFi space faster than probably what they were originally because of seeing the success of it. So the reprioritization is a big one on a lot of these networks. Wonder if you think someone that got into mining with 3000 series cards should be worried about the profit drops, or do you think some older cards will drop off? It's always going to front run efficiency. So cards that are less efficient, by and large, are always going to fall off before cards that are efficient. So like a 3080 gets 100 mega hash, you spend about 240 watts on it, 220, 230 watts on the card. 470, 480s, 580s, less efficient cards, the 1060, 6 gigs, those kind of cards are going to drop off pretty quick and first, but they're going to be redeployed to other networks where they are profitable. So GPU mining, not that everything can hold up GPU mining, it's just circumstantially right now ETH is hyper profitable, and so are a lot of other stuff. Like there's physically not enough hardware available right now for people to where they're not profitable. So like people are not capitulating, they're just seeing a reduction of their yields go down, which circumstantially proportional to price going up is reducing their total profitability, right? So people are looking at that are mining, and some people may not have the palate to see a 50% drop in revenues, and just say, screw this. Even though I'm making money, I'm gonna sell the GPU for double the price, because that's just what market and demand is. It's not that you're trying to screw somebody over. It literally is supply and demand. I put out some GPUs 2 months ago for close to lower than retail origination price. So I had 588 gig cards that I put up for 200 and some change. They instantly sold because I was trying to be like, not screw somebody over, like, hey, this is a 580. I mined with it for 3 years. I bought it for 289 to 329 each card, and I put it up for 200 to 250. Right. And I felt like, hey, it's been 3 years and I'm getting almost 80% of its value. Everything sold. I sold 25, 30 GPUs and they all sold instantaneously. I had a friend do the same thing with his 5700 and 5600s because he just has moving, and he sold 2 rigs. He sold them for a little over MSRP that he had originally. He had bought them for $409 a GPU. He sold them for $450. They were instantly sold. And now all those GPUs are $1,000, $1,200. So if you were to put a GPU up, let's say for 800, it's going on eBay for 1,200. I mean, you're a nice guy, but like, and that's awesome. And if you want to do that, you're leaving about $400 on the table. Just honestly, you are, because people are going to buy it. So I would say maximize without screwing. I would say use your pull your prices into Excel and see what the market average is, see what things are selling for. And if you want to be on the lower end of that spectrum, I think you're doing justice to the supply demand. It's not personal, it's business for people. And if that's where market prices are, that's what market prices are. It's just like, and that's again on the buyer side. If you're buying GPUs, know that you're going to spend a lot more than they're proverbially worth when it came to what the original MSRP, what a vendor has said this was our price point, and they built their entire structure and profitability around. those prices don't mean anything right now in a high demand market. They just don't. I mean, it's like we didn't make up the rules; we just live within it, right? So, like, I try to do the good thing, and I know I left a lot of money on the table because I was selling GPUs for $250, 2 months ago. GPU prices of 5,700 to drop 200 each because of the preemptive decommissions. I think people are actually selling GPUs. That's the difference. Like I said, I know friends and people that have been putting up their stuff because we're getting at the tail end of it. Now, what happens is you have this ebb and flow that can occur on the GPU mining side that, like right now, it looks like the going's good. Your profits are down if you're used to stuff that was in January and February. And then you're going to have you could have a huge gain, like if Fidelity or JP Morgan or somebody opens up their trade desk, and now you can have a huge amount of retail purchasing of crypto, and then this thing moons past anybody could ever. Let's say, one of these major liquidity events occur, and overnight ETH goes from 3,500, 3,400 to $10,000 just because it's just what happens. It goes absolutely parabolic. Well, now those GPUs are like gold mines, right? This is the balance and the risk that we all take with it, that you could sell out of it, and then now GPUs, just because the supply demand go to where a 580 is going for $2,500 because it can generate crazy amounts of money. That's why I like going through forecasting with you guys, because we can actually forecast what happens if ETH goes to $10,000, a coin, right? Like, let's run the scenario on that. And I run that here on this scenario to where in September, like, let's say it goes bananas because of what I just said, and you still had your 883 mega hash, net hash is naturally going up. What do you get? Well, what happens is when February, when your yields were 1 ETH, that's great. You're only earning 0.4 ETH because the net hash went up, but now you're earning 4,200 a month because you're at $10,000 ETH price, you're at Ethereum price. So that's why it's good to forecast a whole bunch of different scenarios. And this is why I try to have these videos with you guys. I mean, I'm turning down a lot of people trying to promote stuff. Like I have Helium, people ask me about Helium Miner and all this. I have Helium reaching out. I have all these different companies trying to reach out to have me promote stuff. And the stuff that I'm trying to give to you guys is something different. Now, I don't get a lot of subscribers and all that kind of stuff. But what I'm trying to show you is the math behind the way this stuff works. The real math and the forecasting, not that right now what your profitability is. I don't care what your profitability is right now. What I'm looking at is that if you make an investment, there's time, there's money, there's setup, there's care and feeding of it. And then what happens with the network and the net hash when it goes up. I want to forecast that. I want to forecast it against times where you have low price and low profit. So if we go to ELPLV, here you go. Like, not saying that ETH would ever drop back down to $86. I don't think that would happen. Personally, I just think the probability would be disastrous and it would not occur. But here's the reality of that. What's 700 net hash, which you wouldn't have 700 net hash. If ETH precipitously dropped like that, your net hash would follow because people would just turn off the rigs. Like immediately you would start seeing people turn off rigs. Like the day it dropped 10,000, from whatever price down to $800, you would have a sharp network decline of hash rate. So these numbers are a little off, but your yields, because the net hash is here. If net hash dropped down to on this number, I'm doing a lookup here. But like if this number was 2 something, you would be earning like 2.6 ETH per month, which would probably still make you profitable if it was at like 200 terahash net hash, because your yields would go up to like 2.6 ETH at $86. You'd be just barely covering your power, right? So it has an ebb and flow with regards to hash rate total versus your yield versus price. But like a lot of people would be like, nope, not worth it to me, which is hilariously ironic to me because your yields go up, right? And this is why people mining, like we had to turn off the farm a couple months when it was $86 back in March last year because our power stays constant. So when power costs are $13,000 to $20,000 a month, and then you're only bringing in
$12,000 a month, then you're out of pocket $8,000. And at that particular time, it wasn't worth us selling $8,000 worth of ETH or ETH price or anything else, because we'd have to give up so much yield on that, and it wasn't worth it. So there is a calculus problem to it, but it's all individual for people. But again, I wanted to make an update video for this. Hopefully this has been pretty good. I'll take a few more questions. I want to keep it right around 45 minutes or so. Mining is a long-term strategy if you're into it, and it's fine if you've dabbled into it, because you've been able, everybody watching this, if you're mining and you have cards, you've already made it. Even if you haven't got a lot of yield, your cards are worth a lot, and if you wanted to come out of those cards, you're still going to make profit on the cards. So it's a segment that is benefiting anybody that's got into it, no matter where you're blindfolded throwing on the dartboard went. Estimated date of proof of stake. So I've been researching, and I'm following the forums. I want to have a separate video with this, with you guys on proof of stake of where it's at. And right now I know that Tim Bianco had mentioned that they're on pace for probably December of this year. I personally, and again, I have no direct influence on this at all, I don't think they're going to make December. I think it's about putting a flagpole down and telling people to kind of like, hey, if you're basing stuff on this, make sure you're making a sound decision, because we have a flagpole where we're trying to hit December. I think the realities is if they wanted to go with just a few clients, they could probably do it, because a couple of those client teams have a lot of resources. And with the prices that ETH is now, and those client teams have large foundations and money, they can hire a lot of developers. They can put, I mean, Vitalik by himself could fund 10 development teams if he wanted to, right? And not even scratch the surface on what he's looking at, right? He could easily drop $30 million and set up 6 teams that are just dedicated supporting all the client teams. It's a really push to shove of what's going to go on. Integration testing, all of that kind of stuff that's going to come through, all their plan testing on it, scenarios, getting test nets set up, configured, having client teams test stuff, having DeFi teams test stuff. Like, there's a lot to it. So I think just if I was a project manager on this, and being a project manager for very large solutions and architectures and development teams, and that touch tens of thousands of people on applications and stuff, this stuff takes time. Even if you're doing a very rapid, agile development, and you have very quick MVPs, which is your minimally viable products, if you have customer buy-in, you have a cadence that allows for rapid development in a decentralized way, you're still looking at a minimum of 6 to 10 months to get enough confidence to flip something into production, in my opinion. So the checkpoint on this point is the client teams for ETH1. So you have 2 different sets of teams. You have client teams on ETH1, and then you have the ETH POS team, which is on ETH2. Those guys right now are working on it. And this is why a lot of the confidence and the December dates are coming out, because you have the ETH2 team that is focused on merge. ETH1 teams right now are trying to go through all their testing and their test stuff for EIP-1559. So why it was accepted a month and a half ago, 2 months ago, it's now going through all the minutia that it needs to test things on test nets and validate things are going to go right. Remember, in Berlin, we had issues where one client issue, I think it was one of the client teams had an issue. Remember when Berlin went live, there was kind of an issue where some funds got locked up and stuff. So, and they did an after action of how that happened and all this, and they're like, hey, we would have never tested this scenario because of the way things are, because our test nets don't look like production. So they're going to take a little more care and feeding to get EIP-1559 in July. If EIP-1559 hits in July and there are no issues with it, so there's no more fire calls on trying to figure out something overnight, then that means the F2 teams, if their priority is 100% to try to merge, then they're going to have like 6 months right? They're going to have from July to essentially December to try to ship it, which means they got to get right on it. They got to get it out to, they got to build out the code. They got to figure out what's all going to be in part of that. If it's just the consensus swap, are they going to allow people to unlock wallets? Like, there's a lot going on with that, and I haven't got clear answers on some of that. And I'm not that they have to tell us that, but if you're an ETH holder and now you're the consensus algorithm on POS, if they just prioritize merge and proof of work goes away, and then let's say you're a 32 locked up ETH holder or you're a derivative holder to it, to where you put in one ETH to a group and now you're one of 32 ETH on a node, your interest payments right now, as far as the network is concerned, with what's important, means that that's just going to continue to go into the account and you can't unlock it. So you got this weird conundrum that they're going to have to work through that I have not heard clarity on, that where we as miners right now are getting inflation, we can redeploy capital because we're paid out for our efforts. There's an ecosystem of inflation that's usable. If they switch to POS and just do the merge and do not allow your wallets to be unlocked, so Beacon Chain will act as Beacon Chain is right now, it just circumstantially it's doing the consensus layer for the network. None of that inflation that is being inflated into those wallets can be withdrawn. Now there's going to be some services oriented architectures laid on top of it where people can create some value movement of their locked up ETH on an exchange, because the exchange will effectively spot price them for the rights to their coins. So like you could borrow against your 32 ETH that's locked up, but then a coin, let's say you get liquidated or something, or sell all those coins that you traded out of, then that exchange inherits your 32 coins that are still locked up, right? They're taking the bet that they're willing to do that. There's going to be some of that activity on there, but I think it's a huge point that hasn't been really discussed in any detail. And I want to drive that point a little deeper once I do more research to figure out, are they actually going to do that, or are they going to have the client teams make it to where you can have withdrawals? The things with withdrawals is like its own, it hasn't been built yet. So there's ideas and there are technical specifications, but ideas and technical specifications turning into software that it works and it's been tested and people can come in and out and unlock periods and all that kind of stuff, all is still getting designed. So that's not going to be their priority based on what I'm seeing. Only the merge is. So how's that going to affect the ecosystem? Now only ETH that's out there is the only ETH that's moving around, and every bit of extra ETH that is locked up, right? So like, let's say the inflation rate's going to go down because proof of stake has less inflation. The extra transaction fees don't go away with the merge. So like this number right here, if we do have a day where 8.5 ETH is moved around in a particular block at the MEV extraction, that is still getting locked up with it. So you would have your 0.5 ETH inflation or whatever it ends up being, because it's all predicated to how many people are locked up. Or let's say it's 0.125, you could potentially have 7.875 ETH locked up into these, whoever the block producer is, and now it's coming out of supply immediately. So that would be effectively, it's not a burn, but it's to where you can't move that money around anymore. So it's great if you're a proof of staker and you win that opportunity to mint that block, and now you've gotten 8 ETH as a block producer. Cool story. It's locked up. You can't move it. So I'm interested in that point. I've belabored it a lot. Hopefully you guys don't think it's too heavy of a conversation, but this is the stuff that I'm researching, that I'm trying to make sure I can articulate to you guys appropriately to lay out the risk and the issues with it. And as an ETH holder, as a person, we still haven't done a lockup of 32 ETH. We're talking about it. If we're going to do it, if I'm going to do it personally, I want to know more. I want to punch holes and make sure that they're thinking through it. I would imagine they are, but nothing like somebody prodding you on the side to try to get you to look more into it. All right, my dudes, I think I'm going to start to wrap. The merge is the ending of mining, and that's the conversion of POS. Yes, that's it. So yeah, I don't know if I ever gave you a timeline. I think March next year at the minimum, or yeah, at the minimum, and it could go another 6 months past that. They have to give it. They have to do it right, guys. Like this isn't like fake stuff now. This is almost a $750 billion network. They're not going to mess it up. They're going to have a lot of audits. They're going to have like there's just too much. It's too big to fail type of thing. So they're going to have to get it right. So I personally think the mining still got close to a year left in it. Personally, if they make it December, it's going to be amazing to me because that means like 3 months after EIP-1559 drops, they're going to have to be in testing, like deployed testnet testing, with it going into a hard fork in December. Like I just don't see the flash to bang how the client teams get where they're at now to implementation by October. I just don't see that. I don't the way the machine works right now has never worked in that rapidity, that quickness. That's why they gave it a 2-year plan. And that's why my EIP I proposed was making sure that mining would have a tell off and then allow people to kind of orchestrate their setups around that tell off. I mean it could be a couple years, but they're aiming for December. So if you're planning on that, again, make your forecast. Make your forecast of what happens if they do go live and you cannot mine ETH anymore in December. That's your checkpoint. My best guess would be the March, April next year. Awesome, my dudes. I'm gonna wrap this up. Thanks again for joining. Dogecoin video was yesterday, so if people are asking about Dogecoin, I did a video yesterday on Dogecoin, and I will catch you guys on the next one. Hopefully, we can have a proper video. I got another interview coming up here for an editor that I'm doing, and then yeah, I'm gonna get back to the day stuff, and I'll see you guys in the next couple days. Peace. Be sure to subscribe, share, and like if you like this content. I usually deep dive pretty deep on some of these things.